Hi, the discounting of cash flow is a technique that is widely used in finance. It is used in deciding whether major corporate projects are undertaken, whether investment in shares and bonds are worth the price quoted. What is discounting of cash flow, which is also known as DCF in short? Discounting of cash flow is basically a way to determine how much you should invest today for an amount you expect to receive in the future. In the example given, if an investment is expected to give you a single payment of $300 in 2 years' time, how much should you pay for it today, or how much should you invest today for it? Well, it depends. It depends on the rate of return you want on your investment. In the given example, we assume that your required rate of return is 15% per annum. The relationship between the rate of return and the amount to be invested is simply this. The higher the rate you want, the lower the amount you would pay for an investment. Vice versa, the lower the rate you are willing to accept, the higher the amount you would pay for an investment. The amount you would pay for an investment is inverse to the rate of return you require. You have a required rate of return because you have opportunity cost. You could invest somewhere else and get a certain return on your investment. In the given example, you expect $300 in 2 years' time from the investment, and your required rate of return is 15% per annum. The $300 you expect to receive in 2 years' time has to give you 1. The 2-year compounded return at 15% per annum that you want, and 2. The amount you are investing today for the $300. In the next slide, we will look at how, using the DCF formula, PV equal to FV divided by 1 plus R over 100 to the power of N will help you to work out the amount you should invest today. PV is the present value of the future amount you expect to receive from the investment. It is also the amount you should invest today for the future amount. FV stands for future value. It is the future amount you expect to receive from the investment. R is the rate of return you require, and in the formula, it is expressed as a proportion of 100. That is, in decimal form. N is the number of compounding period from the time the investment is made to the time the payout is received from the investment. We calculate the amount you should invest today using the discounting formula. PV, or the present value, is the amount to be invested today. Applying the DCF formula, we divide the future value of $300 with the discount factor of 1.15 to the power of 2. The present value, or the amount to be invested today, is $226.8431. Subtracting the investment of $226.8431 from $300, we calculate the 2-year compounded return to be $73.1569. $73.1569 gives you the 15% per annum 2-year compounded return that you won. To prove it, let us calculate the first year return on the initial investment of $226.8431. 15% of $226.8431 is $34.0265. The first year return at 15% is $34.0265. To compute the second year return, we take 15% of $260.8696 and not 15% of the initial investment of $226.8431. $260.8696 includes the first year return of $34.0265. This is what is known as compounded return. 15% of $260.8696 is $39.1304. The second year return is $39.1304. The sum of the first year return of $34.0265 and the second year return of $39.1304 is $73.1569. Both for the first and the second year, we had used your required rate of 15% per annum, thus proving that $73.1569 gives the 15% per annum 2-year compounded rate that you won. In conclusion, investing $226.8431 and getting back $300 in 2 years' time, you would be getting back your initial investment of $226.8431 and the 15% per annum 2-year compounded return that you won. This short slideshow on the discounting of cash flow is sponsored by Excel Academy at teachable.com. Excel Academy specializes in finance education. Check out our latest course, Appraising Projects and Assessing Project Risks, which is designed for non-finance executive and professionals.